You are paying a tax rate that the wealthy have not paid in decades, not because they earn less, because they know something about the tax code you were never taught. And the gap between what you pay and what they pay is not an accident. If you are watching this, you already see money differently than most. The fact that you found this tells me something important about you. Most people scroll past information like this. You did not. In this video, I am going to show you 10 specific legal strategies the wealthy use to reduce what they owe the IRS, not loopholes in the illegal sense. Rules written into the tax code by design. Some require owning businesses, investments, or significant assets to fully access, but most people never even hear about them. By the time we reach number 10, you will understand why the wealthy and the working class play a completely different game, and why the game was designed that way. Here is the part that should make you pause. The top income tax bracket in the United States sits at 37%. Most working professionals pay between 22 and 32%. Yet a 2021 investigative analysis found that some of the wealthiest Americans paid effective federal tax rates in the single digits, not through evasion, through strategy. The IRS tax code runs nearly 10,000 pages. The wealthy have teams of people who read every single one. You were given a W-2 and a free filing website. When you study the tax code closely, the incentives clearly favor ownership over labor. Here is exactly how it works. Number 1. Income type is everything. Not all income is taxed the same. The money you earn from a paycheck is called ordinary income. It is taxed at your full marginal rate. The money earned from selling an investment held longer than 1 year is called long-term capital gains. Long-term capital gains are taxed at 0, 15, or 20%, depending on total income for the year. Picture this. 2 people each clear $200,000 in a year. One earns it through salary. One earns it through appreciated investments. The salary earner might pay 32%. The investor might pay 15%. Same income, different rules. The wealthy do not earn money. They harvest it. Number 2. The step-up in basis rule. When a wealthy person holds an asset their entire life and passes it to their heirs, something extraordinary happens. The cost basis of that asset resets to its current market value. This is a provision written directly into the tax code. Whatever gains accumulated over decades simply disappear from a tax standpoint. Picture this. Someone buys stock worth $100,000 in 1980. By the time they pass, it is worth $4 million. Their heir inherits it at $4 million. That $3.9 million in gains is never taxed. It does not defer. It vanishes. The IRS calls this the step-up in basis. Families who understand this rule build multi-generational wealth. Families who do not pay. Number 3. The business deduction machine. When you own a business, the tax code allows you to reduce your taxable income by the cost of running it. Legitimate business expenses come off the top before the IRS touches your income. Office space, equipment, travel, health insurance, retirement contributions, vehicles used for business, home offices, professional education. A business owner earning $500,000 might have $300,000 in legitimate deductions. They are only taxed on $200,000. The employee earning the same amount has almost none of these options. The tax code was not written for people who work for others. It was written for people who own things. Here is where it gets uncomfortable. Number 4. Depreciation. The paper loss that saves real money. Real estate owners receive one of the most powerful tax tools available. The IRS allows them to deduct the theoretical wear and tear on a building over time. This is called depreciation. It produces a loss on paper even when the property is generating positive cash flow. Picture this. A real estate investor earns $40,000 in rental income. After depreciation, they report a taxable loss on paper. They pay almost nothing in taxes on that income. Meanwhile, the property appreciated in value and they collected rent. Depreciation is wealth tax-shielded from the beginning. A paper loss with a real return. Number 5. The health savings account nobody talks about. This tool is available to anyone with a qualifying high-deductible health plan. It is not exclusive to the wealthy, but the wealthy maximize it fully. Under current IRS limits, an individual can contribute several $1,000s annually. A family can contribute roughly double that amount. The IRS adjusts these limits periodically for inflation. Every dollar contributed is tax-deductible going in. It grows tax-free inside the account. Withdrawals for qualified medical expenses are also tax-free. That is triple tax advantage. No other vehicle in the tax code offers this. And if you do not use it for healthcare after age 65, it converts into a standard retirement account. The HSA is not a healthcare account. It is a stealth retirement account with extra benefits. Most people do not use it that way. Most people never connect these two things. Number 6. Opportunity Zone Investments. In 2017, the government created a program to encourage investment in economically distressed communities. Investors who direct capital gains into designated opportunity zones can defer taxes on those gains for a period of time. And if the investment is held long enough, the appreciation earned inside the zone may become tax-free entirely. Picture this. An investor realizes a $500,000 capital gain. Instead of paying the tax, they roll it into a qualified opportunity fund. After 10 years, the fund has grown to $1.2 million. No tax owed on that appreciation. The original gain deferred. The new gain potentially eliminated. Wealthy investors have placed hundreds of billions into these zones. Most working Americans have never heard of them. Visibility is a form of privilege. Drop in the comments which one of these has surprised you most so far. What we are covering right now goes deeper than most people ever discover on their own. The strategies, the actual structures, the numbers behind the numbers. We go further inside the Luxona vault. Link is below if you want in. Now, let us keep going. Number 7. The Backdoor Roth IRA. Traditional Roth IRA contributions phase out above a certain income level. The IRS adjusts that threshold periodically, but for most high earners, it is out of reach. Most high earners assume the Roth is simply unavailable to them. They are wrong. There is a legal process called the Backdoor Roth. You contribute to a traditional non-deductible IRA, then immediately convert it to a Roth. The conversion is legal and widely used among high earners. It is written into the tax code and available to those who know to ask. Almost nobody without a financial advisor knows it exists. The tax code does not advertise its workarounds. Number 8. Charitable remainder trusts. This strategy sounds complicated, but the structure is simple. You transfer a highly appreciated asset into a specially structured trust. The trust sells the asset without triggering immediate capital gains tax. You receive an income stream from the trust for a set period of time. At the end, the remainder goes to a designated charity. You also receive a partial charitable deduction in the year of the contribution. Picture this. Someone holds $2 million in stock they purchased for $200,000. Selling it outright triggers significant capital gains tax. Instead, they transfer it into the trust. The full $2 million is reinvested tax-free inside the trust. They receive income for 20 years. The charity receives what remains. The IRS received far less than it would have in a direct sale. Generosity and tax efficiency are not mutually exclusive. This is where the system becomes visible. Number 9. Qualified small business stock exclusion. Under Section 1202 of the Tax Code, investors in qualifying small businesses can exclude up to 100% of capital gains on that investment. The gain exclusion is capped at $10 million per investor. For startup founders and early investors, this provision alone can represent a tax saving in the millions. You buy stock in a qualifying C corporation at the ground level. You hold it for more than 5 years. When you sell, the gain may be completely tax-free. This provision was designed to encourage investment in small businesses. It was largely absorbed by venture capital and startup culture. The wealthy found it. They funded it. They exempted it. Number 10. Paying yourself last, or not at all. The wealthiest people in the world often take almost no salary. Elon Musk, Jeff Bezos, Warren Buffett. Their official compensation on paper is often near zero. Instead, they hold ownership. Their wealth grows through asset appreciation. They live by borrowing against those assets at low interest rates, rather than selling them and triggering a taxable event. This strategy is called buy, borrow, die. It is important to understand clearly. This is not a tactic available to ordinary people. It requires massive asset wealth as collateral. It requires institutional lenders willing to extend credit against billions. And at the scale it operates, carrying debt is still carrying risk. But the mechanism reveals something important. The tax code does not tax wealth. It taxes income. When your net worth is large enough to live on borrowing rather than earning, the income tax system barely touches you. The wealthy do not earn money from labor. They exist in a different category of the tax code entirely. But here is what none of this is really about. This video is not really about taxes. Taxes are just the mirror. The real pattern behind every single item on this list is the same pattern: ownership. Every strategy here rewards people who own things: assets, businesses, real estate, equity. The tax code was not designed by mistake. It was written by and for people who understand that income is for employees and wealth is for owners. Every paycheck is a transaction. Every asset is a compounding machine. The wealthy do not work for money. They build structures that generate it, and the tax code rewards those structures at every step. Most people spend their whole lives in the income column. The wealthy live in the ownership column. That is not a political statement. That is the design. The strategy is not to find clever loopholes. The strategy is to shift from earning to owning, step by step, year by year. It does not require being rich to start. It requires being intentional before everyone else. Luxonians do not wait for the system to invite them in. They learn how it works and they position themselves accordingly. The next video takes this further. Wealth is not built through tricks. It is built through clarity, consistency, and ownership. Welcome to Luxona, where millionaires are made.